Have you ever felt a nagging disconnect between official economic reports and your daily reality? The numbers might suggest inflation is cooling, yet your grocery bill tells a different story. This isn't just a feeling. It's a profound experience shared by many, creating frustration and even a sense of invalidation. It's time to bridge this gap, to understand why inflation today feels more personal, persistent, and disruptive than ever before. This isn't about blame or fear. It's about empowerment through understanding. By calmly analyzing the forces at play, we can gain clarity, make better financial decisions, and navigate these economic shifts with greater confidence. This video is designed to illuminate the complex landscape of modern inflation, helping you understand why it feels so different from past experiences, even when official data points to improvement. Whether you're a consumer managing a household budget, an investor planning for the future, or a student eager to grasp economic realities, this insight is crucial. By the end of this journey, you will clearly understand how inflation is measured versus how it is truly experienced in your daily life, why today's inflation feels uniquely personal and persistent, and why disagreements about inflation are common during periods of economic transition. This isn't about predicting the future or assigning blame. It's about providing you with the knowledge to interpret economic signals calmly, empowering you to make informed decisions for your financial well-being. Inflation, at its core, is a rate of change. It quantifies how quickly the general price level for goods and services is rising over a specific period, typically measured year over year. Think of it like the speed of a car. A lower inflation rate means prices are increasing more slowly, not necessarily that they are falling. This distinction between the rate of price increase and the absolute level of prices is absolutely critical. When inflation slows from, say, 9% to 3%, it means prices are still going up, just not as rapidly. The prices you pay at the store remain elevated from their previous levels, even if the pace of their ascent has decelerated. For many, this creates a significant psychological disconnect. Official reports celebrate a declining inflation rate, yet consumers still face high prices for everyday necessities. This isn't a contradiction. Both statements are true simultaneously, reflecting different aspects of the same economic reality. Understanding this helps us calmly interpret headlines and focus on our personal financial situation. Inflation statistics, such as the Consumer Price Index, CPI, are powerful tools, but they are inherently averages. They attempt to capture the typical spending patterns of a broad population, smoothing over vast differences in individual circumstances. This averaging process can obscure the very real and varied experiences of people across different regions, income levels, and spending habits. Consider how different a household's budget might look depending on where they live. Housing costs in a major metropolitan area can dwarf those in a rural town, yet the national average attempts to encompass both. Similarly, a family with young children will have a different spending basket than a retired couple, with varying sensitivities to price changes in specific categories like childcare or healthcare. People don't live in averages. They live in their specific financial realities. If your personal budget is heavily weighted towards categories that continue to see significant price increases, like rent, insurance premiums, or specific food items, then the overall inflation rate might feel irrelevant. This lag between aggregate data and individual experience is a key reason why inflation feels so persistent and personal, even when the headline numbers suggest improvement. It underscores the importance of personal financial literacy, allowing you to analyze your own situation rather than relying solely on broad economic indicators. Not all price increases are felt equally. When the cost of discretionary items, like a new gadget or a restaurant meal, fluctuates, people often have the flexibility to adjust their spending or defer purchases. These changes, while noticeable, typically don't trigger the same level of anxiety or financial strain. However, when the prices of essential goods and services rise, the impact is profoundly different. Categories like housing, food, energy, and healthcare are non-negotiable. They are fundamental to daily living. Increases in these areas directly affect a household's ability to meet basic needs, making inflation feel far more personal, urgent, and emotionally charged. For many, a significant portion of their income is dedicated to these necessities. When these costs climb, It leaves less disposable income for everything else, squeezing budgets and forcing difficult choices. This phenomenon is often referred to as inflation inequality, as lower-income households disproportionately spend a larger percentage of their income on essentials, making them more vulnerable to rising prices in these categories. Understanding this dynamic empowers us to prioritize our spending and advocate for policies that address the cost of living for all. Inflation isn't a monolithic force. It can stem from different underlying causes, each with distinct implications for its persistence and our experience. We can broadly categorize inflation as either cyclical or structural, and understanding this difference is crucial for a calm and informed perspective. Cyclical inflation is often tied to the ebb and flow of the business cycle. It rises during periods of strong economic growth and high demand, and typically recedes during economic slowdowns or recessions. This type of inflation is generally more transient, responding to short-term supply and demand imbalances. Think of a temporary surge in demand for certain goods after a stimulus or a brief disruption in a supply chain. Structural inflation, however, is rooted in deeper, more fundamental shifts within the economy. These are long-term trends that can exert upward pressure on prices for extended periods, making them much harder to reverse. Examples include demographic changes, such as an aging workforce leading to labor shortages and higher wage demands, or significant supply constraints due to geopolitical events or climate change impacting resource availability. Other structural factors might include increased regulatory costs, shifts in global trade patterns, or a sustained lack of investment in critical infrastructure. When structural factors are at play, prices don't easily revert to previous levels. This type of inflation feels more entrenched and explains why relief can be slow, requiring more fundamental economic adjustments rather than just a cyclical downturn. Recognizing these underlying forces helps investors and policymakers alike understand the long-term trajectory of prices. One of the most frustrating aspects of inflation for many individuals is the perceived mismatch between rising prices and stagnant or lagging wages. Even when official data indicates that wages are increasing, they often fail to keep pace with the cumulative effect of prior inflation. This creates a pervasive sense of falling behind, where purchasing power erodes despite nominal income gains. The timing of these adjustments is a critical factor. Prices for goods and services can often react quickly to market forces, supply chain disruptions, or changes in demand. Wages, on the other hand, tend to be stickier. They typically adjust more slowly, often through annual reviews, collective bargaining agreements, or competitive pressures that take time to materialize. This lag means that by the time wages catch up, the cost of living may have already moved higher, perpetuating the feeling of a treadmill where you're running faster just to stay in place. This dynamic significantly impacts personal finance. It can erode savings, make budgeting more challenging, and force individuals to reevaluate their financial goals. For investors, understanding this wage-price spiral dynamic is crucial for assessing corporate profitability and economic stability. Recognizing this inherent mismatch helps us manage expectations and focus on strategies to protect our purchasing power, such as investing wisely or seeking opportunities for income growth. Inflation is not merely an economic phenomenon. It is profoundly psychological. Our perceptions and expectations play a significant role in how we experience and react to price changes. For decades, many economies enjoyed a period of relatively low and stable inflation, leading to a collective complacency. People simply stopped paying close attention to price movements, assuming stability. However, when prices begin to rise unexpectedly and rapidly, as they have in recent years, public attention intensifies dramatically. The memory of these rapid increases can linger long after the official inflation rate begins to decline. This psychological anchoring means that even when prices are rising more slowly, the memory of higher prices can make current costs feel disproportionately expensive. This can lead to a heightened sensitivity to any further price increases, even minor ones. Moreover, expectations about future inflation can become a self-fulfilling prophecy. If consumers and businesses expect prices to continue rising, consumers may accelerate purchases and businesses may raise prices preemptively, contributing to actual inflation. This psychological component underscores why central banks pay close attention to inflation expectations. For individuals, understanding this psychological aspect empowers us to approach economic news with a calm, analytical mindset, rather than letting past experiences unduly influence our current perceptions. In today's economic climate, it's common to hear vastly different perspectives on inflation. Some individuals point to official government statistics, highlighting declining rates and suggesting that the worst is over. Others, however, vehemently argue that their lived experience, the cost of groceries, rent, or fuel, tells a completely different story, one of persistent and painful price increases. Neither perspective is inherently wrong. They are simply answering different questions and using different lenses to view the same economic reality. Those who rely on official data are typically asking, how fast are prices changing on average across the economy? Their focus is on the rate of change, often using broad indices like the CPI. Conversely, those who rely on lived experience are asking, how does my personal financial situation feel right now? And can I afford my daily necessities? Their focus is on the absolute level of prices for the specific goods and services they consume and the impact on their household budget. The confusion and disagreement arise when these two distinct questions are treated as if they should yield the same answer. Understanding this fundamental difference allows for more productive conversations and helps us appreciate the diverse impacts of inflation across society. It encourages empathy and a more nuanced understanding of economic discourse. To truly understand why inflation feels different today, it's helpful to look back at history. Economic transitions, particularly those involving significant inflationary pressures, are rarely smooth, linear processes. Past periods of rising inflation have consistently been followed by long, often uneven adjustments, and a lingering perception of high prices even after the official data shows improvement. Consider the inflationary periods of the 1970s and early 1980s. Even after inflation rates began to decline, the memory of soaring prices and the erosion of purchasing power persisted for years. The economic landscape had fundamentally shifted, and it took time for wages, expectations, and consumer behavior to adapt to the new reality. This historical perspective teaches us that economic recovery from inflation is not like flipping a switch. It's a gradual process, often characterized by fits and starts, and uneven relief across different sectors and demographics. This doesn't mean that inflation never improves or that we are doomed to perpetual high prices. Rather, it means that the path to price stability is often slower and more complex than many expect. By understanding these historical patterns, we can approach current economic challenges with greater patience and a more realistic outlook, avoiding the emotional swings that often accompany economic uncertainty. It empowers us to learn from the past to better navigate the present. Given the complexities we've discussed, constantly asking, is inflation over, can be a misleading and frustrating question. It implies a sudden, definitive end to a process that is inherently gradual and uneven. This binary thinking often leads to disappointment when the reality doesn't match the expectation of an immediate return to normal. A more useful and empowering question to ask is, which prices are still adjusting and why? This reframes inflation from a single, abstract number to a dynamic, ongoing process. It encourages a more granular and analytical approach, prompting us to look beyond the headline figures and examine the specific categories that impact our lives most directly. Are housing costs still climbing due to structural supply issues? Are food prices elevated because of global supply chain disruptions or weather events? By asking these targeted questions, we shift our focus from a generalized anxiety to a more informed understanding of specific economic forces. This perspective allows us to identify areas where prices might remain sticky and where relief might be slower to arrive. It transforms inflation from an overwhelming, monolithic problem into a series of manageable, understandable challenges. This calm, analytical approach empowers us to make better personal financial decisions, adapt our budgets, and plan for the future with greater clarity. This episode has provided a crucial foundation, explaining why inflation feels so different today. We've explored the disconnect between data and experience, the weight of essential costs, the impact of structural changes, and the psychological aspects that shape our perceptions. This understanding is not just academic. It's a vital tool for your financial literacy and personal empowerment. In our next episode, we will build upon this knowledge by exploring another fundamental economic concept: interest rates. We'll delve into why interest rates affect virtually everything in the economy, even for individuals who aren't directly borrowing money. Inflation and interest rates are deeply interconnected, influencing everything from your savings accounts to investment returns, and understanding their relationship is key to navigating today's economic landscape. We will uncover these connections, often in ways that are not immediately obvious, further enhancing your ability to make informed and confident financial decisions. You now possess a deeper understanding of why inflation feels so different and challenging in today's world. You recognize that inflation is measured as a rate, but profoundly experienced as a level, creating a natural disconnect. You understand that essential costs carry immense emotional and financial weight, making their increases feel more personal and persistent. Furthermore, you've learned that structural economic changes adjust slowly, contributing to the prolonged nature of current price pressures, and that personal experience often lags behind official data improvements. With this comprehensive understanding, inflation becomes less of an abstract, anxiety-inducing force and more of a comprehensible economic process. This knowledge empowers you to interpret economic news calmly, make more informed financial decisions, and approach your personal finances with greater confidence and less emotional overwhelm. You are now better equipped to navigate the complexities of our economic reality. Please like this video if you have enjoyed it or received any benefit from it. Every one of your likes truly encourages us to continue creating helpful content. Thank you for watching and have a blessed day.